Chief Investment Officer at Trust Mutual Fund. Mihir has 30 years of experience managing funds in India, working with multiple mutual funds in the past. Prior to joining Trust Mutual Fund, Mihir was managing 1.3 lakh crores as CIO of Max Life Insurance. Welcome, Mihir. How are you doing?
All good, and thanks for doing this conversation.
Thank you so much for joining me. So let's get started by addressing the white elephant in the room. We're at a time when there are geopolitical tensions, there is trade-related uncertainties. Can this slow the India growth story?
Look, India has seen a lot in the last 30 years that I've seen my career. We've seen all kinds of extreme events and geopolitical, political, military, natural disasters. Basic lesson to be learned in the last 30 years is that the India story doesn't stop, right? If you talk about the recent past where you're referring to the Trump tariffs, let's step back and see what's happening, right? India structurally is the only country in the world which will grow its workforce in the next 20 years, the working age population, right? We're going to add 15 crore people in the age group of 25 to 50 years of age in the next 20 years. China will lose 12 crore people. Europe will lose 5 crore people. Japan will lose 1 or 2 crore people, right? That population cannot be replaced. This is the consuming population, this is the saving population, and this is the producing population. So there is a shortage, there's going to be a shortage of workers in the world, and India is the only country who can provide it. So structurally, the story is so strong that these things don't matter. But even if I were to delve deeper into the Trump issue, what has he done after 2nd May, right? He announced, and then successively he has been retracting one by one. Against each country he's been backtracking. Against India also he's started negotiation. With China also he's backtracking, and China of course has a lot of cards to play in terms of rare earths, etc., as we know. So the point is that the world is now beginning to understand in the last 2 months that it's a taco trade, right? Trump always chickens out, and we have seen that. That's a fact. But from the last tweet that President Trump has come out with, it looks like China is going to be at about 50% to start with, and the reciprocal against the US will be about 10%. 50% against China, and I'm sure its allies like Vietnam, etc., is a lot, right? That can give India a significant advantage because there will be some tariffs against India too, but I don't think it will be as high as 50% because I think we've done our negotiations and we've been doing our negotiations with US even before May. So we are at very advanced stages of arriving at some kind of understanding. So net India should turn out to be a winner in the relative scheme of things globally. Second is, forget the tariff part. Again, I'm coming back to basic fundamentals and strategic importance of India. Forget the tariff part. After COVID, and in the last 2 years even more, it is very apparent to the Western world, the developed world, that China can be a threat politically, economically, as well as militarily, right? So the move to diversify away from China, the China plus one story as we call it, is only getting stronger. We've seen that China in critical times has stopped supplies of critical drugs during COVID.
Yes.
Recently, they are threatening to stop the supply of rare earth minerals, which are required for most of the industries. So China, though it produces now 70 to 90% of a lot of things, it cannot be relied upon in critical times. So this move away from China logically should come to India and a lot of other countries. And even if a small portion of production comes from China to India, it's a large amount for India, right? So I think we should ignore the noise. There will be volatility. I'm not saying that there won't be volatility, but just ignore the noise and look at the longer term, which means that you have to buy any panic dip that happens because of these kind of issues.
Interesting. So while we're maneuvering these volatile and uncertain times, the FII flows have sort of taken a breather. What does this signal for the Indian equity story?
I think the FII flows stopped because of I think three key reasons, I would say. One is, the biggest one was the strength of the dollar. So when we talk about FII flows being negative, they have been negative since September, right? From September 24 to about January, February 25, we've seen FIIs with large sellers. Now that, by no coincidence, was because of the dollar strength, right? And why did the dollar strength happen? By the way, when the dollar was not strengthening, we were actually receiving inflows. So from January 2024 to August 24, we actually saw FII flows being positive for India. So it's not like they are permanently getting out of the country or anything like that. It's just that in the last 3 months of 24, the negative outflows were huge, right? So for the full year, it became negative. But the key reason, I think, why the dollar strengthened last year, and I don't think it's going to happen this year, we'll delve into that too. The key reason why the dollar strengthened is that For the first time in history, I would say, or at least in my memory, the Fed cut rates for the last 1.5 years, but the long bond yields in the US did not go down. So this was a unexplained movement, and because of the strength of the or interest rates in long bonds, I would say the dollar started strengthening, right? And that was because it's a carry trade. Like when the when the US long bond yields are high, then you see money being pulled into the US. That's been the historical correlation. So that correlation held on till about Jan-Feb this year. What has happened now is that because of a lot of actions by Trump and the fiscal situation in the US, and the proposed budget in the US also has no reduction in fiscal deficit. Now the market is starting to panic and say that forget the rates in the US, the currency might be an issue. So in spite of high interest rates in the US, high interest rates not in the short term, but the long bond yields. So short term has been brought down, but the long bonds held on. Now, in spite of high long bond yields in the US, the dollar is beginning to weaken. So this is actually a very clear signal that the world is now fearing that the US fiscal deficit and trade deficit both are out of control. So it's actually a question mark on the US currency, and you see not only flows coming into India. I think we'll see flows coming back to India. By the way, in the last couple of months, anyway, they've started turning positive, or at least the selling has stopped, right? But it's also reflecting in gold. It's also reflecting in silver, right? So this anti-dollar trade, if it accelerates, then you can see a huge amount of money coming not only into India but other emerging markets like Brazil, etc.
Interesting. So while the India party is expected to continue, how has been the recently concluded quarterly earnings season?
So I would say it's been a mixed bag, but with a positive bias, right? While the overall earnings growth has been about high single digits for the 500 companies or so in the universe, the good part about the earnings season has been that we have seen a lot of upgrades. So out of the BSE 200 companies, more than 50% of the companies actually demonstrated results which are a little better than expected, and that's happening after a long time. After many quarters, we are seeing that the positive surprises have been better than the negative surprises, so to say. So I think our basic thesis is that the second half of the year should see a pickup not only in urban consumption, which is still a bit of a weak link, and private sector capex, but it should also see earnings upgrades happening because of that. And that I think the market is looking at already, and we are seeing some amount of positivity in the market because of that.
So on the back of this positive note, what is your view on the current stock selection and sector weightages?
So for a long period of time, and I think this is going to continue for a while, our core view has been that the Indian domestic economy will be better than most of the other developed economies as well as China. So I'm talking about GDP growth rate. So Indian GDP growth rate at 6 to 8%, say 6.5 to 7 on an average, should be better than what we are going to see in China, in the US, in Europe. Europe will be like 1%, US will be like 2.5%. India is far, far better. It stands head and shoulders above most of the other economies in the world, most of the other large as well as small economies in the world. So the domestic growth story is far stronger structurally, and that's the reason why I believe that the domestic sectors, domestic linked sectors, will do better in the long term as well as in the short term. So what do we mean by domestic linked sectors? We mean sectors which are linked to consumption. We mean sectors which are useful in physical asset creation, because that's a big theme that we are paying, industrials, capital goods, real estate, construction. Within industrials and capital goods, you have subsectors like defense, railway, power, T&D. So those segments will grow structurally faster, because that's where the push is required to push the GDP growth rate from 6.5% to 8%. So if our aspiration is 8%, then this physical asset creation theme has to do well. Then we talked about the demographics theme, which means premium consumption items, all kind of services and goods which are premium in nature should do well. Again, linked to demographics is the capital markets theme or the savings link theme. There you have sectors like insurance, wealth management, brokers, capital market, exchanges, asset management, the AMTs, etc. So that bunch, I think we will continue to remain overweight on, and results also have been decent for this bunch. The third thing that we like is digitization and disruption in technology, which means that the new age companies, either B2B or B2C, should grow faster than the rest of the economy. So there also we want to pick stocks in a with a long term view.
So your multi-cap NFO is around the corner. Can you tell us a little bit about the multi-cap fund? What is the strategy that this fund or this scheme will be following?
Sure. So we already have two funds, which is the flexi cap fund and the small cap fund. This is the third offering. Uh, the key idea, of course, is to offer a wider basket to the customers. But more important than that is the fact that we are definitely of the view that stock picking can lead to a lot of alpha. And we believe that the broader market is actually doing better than the pure large caps, right? That means mid cap and small cap offer equal opportunities in the investment space. What happens in most other funds is that there is no minimum allocation that one is to put into mid caps and small caps and large caps. In the multi cap fund, there's a minimum 25% allocation each to small, mid, and large. So 75% of the allocation has to go in these segments. The 25% can be in any other segment, including mid, large, and small. So I would say this is discipline through diversification, right? So there is a minimum that the fund manager has to do in terms of mid and small cap exposure, which means that he'll be forced to do stock selection, right? And which we believe is going to add alpha in the longer term. So if you look at the last 10 years of history, NSE 500 index has done, in a certain way, but the NSE 500 multi cap index, which is a variation of the NSE 500 index, actually done a little better. Of course, that's also a function of the fact that mid caps and small caps have done better than large caps in the last 10 years. But it also shows that if you do the stock picking right, you can generate significant alpha, and that's where the multi cap fund comes into the picture.
Discipline diversification is a very well way to put it. So, how there are more than 5,000 listed stocks. In this format of discipline diversification, what is the stock selection process across mid, large, and small cap companies?
So where the core philosophy remains the same, we are growth investors by nature, and the framework that we use to select stocks is growth at reasonable valuations. But within that, the way we differentiate ourselves, and which we believe is our unique, or secret sauce or chemistry, whatever we say, is our approach of terminal value investing. So when we say growth at reasonable valuations, the way do we look at valuations is through the terminal value prism, and that core of terminal value is the fact, I would say, that for high growth stocks and sectors, what is more important compared to the next few years of profit growth, what is more important is the length of the runway of the profit growth time periods. So if the stock or the segment is expected to grow profits at high rates for a very long period of time, then what happens is that the near term profits, the next few years of profits, don't determine the valuation of the company. The valuation of the company gets determined by the longer term profit pool that is going to come in. So the key to these stocks, the key to selecting these stocks, I would say, is to take a view on the length of the runway. It's not easy, but if you can do it right, even if you're right by half of the, with a 100% margin of error, you can make a lot of money, because these are the stocks which will compound earnings for a long period of time, and these are the stocks which will give you compounded stock price returns because of that.
Interesting. And is this the same philosophy that you follow across your other two schemes, the flexi cap and the small cap?
Absolutely. So whether it's a small cap stock or a mid cap stock or a large cap stock, the stock selection philosophy remains the same. What changes is the mix, right? The relative mix across different funds. Within stock, I would say we do some kind of risk control. So if it's a small cap stock, we typically not own more than 2 to 4% in the portfolio. If it's a mid cap stock, it will be probably 3 to 5%. For the large cap stocks, we can go a little higher on a per stock basis. At the portfolio level, we would also look at deviations of the entire sector weightage in the portfolio versus the benchmark. So we do some kind of diversification sanity check. So the key to our approach is that we are not afraid to take bets against the benchmark. Our tracking error or active share of the portfolio, as you would call it, tends to be higher, which means that we are deviating against the benchmark in our effort to create alpha. So that approach, will remain the same. We are here to generate significant alpha and beat the benchmarks significantly over the longer term.
In a pursuit to seeking alpha, terminal value investing, long runway of growth, how important is earnings, the near-term earnings?
While, as I mentioned, in the terminal value framework, the longer term earnings matter a lot more than the near term earnings. But when we talk about near term earnings, we are talking about 1 or 2 years or 3 years of growth. What happens is that we are tracking our stocks and companies on a very, very close basis, very, very active basis, quarterly basis, or as and when there is a development in the company. What we see is that expectations change with outcomes, right? So in a quarter, if a company is expected to deliver a certain profit growth, and if the profit growth is above or below that, then there is a slight upward or downward reset in future expectations. And those expectations start getting magnified. So 1 or 2 quarters is fine, but if there's a consistent trend where the company is surprising on the upside, beating expectations consistently on the upside, quarter after quarter after quarter after quarter, then the expectations will run up on an exponential basis, which will lead to not only a earnings revision on profits, but it will lead to a valuation upside also. So for us, it's the core valuation of methodology of terminal valuation does not necessarily mean we have to track quarterly numbers, but we try to see the expectation changes, and that's why apart from growth in profits, we keep a very close tab on earnings revisions, whether the stock is beating expectations consistently or disappointing expectations consistently, and if there is a trend that we can see, we take corrective action.
Interesting. Now, Mihir, shifting gears a little bit, the equity market flows have reduced recently. Is this a concern for the broader equity story? Is it losing steam?
I would not say so. If I break up the net flows into mutual funds on a monthly basis, it's divided into SIPs and the non-SIP flows. The SIP flows are very, very granular in nature. It's like millions of people putting in small amounts every month. And that we have seen is very, very stable and rising consistently. So quarter after quarter, month after month, if you see, the SIP inflows have been very consistently on an upswing. So I'm not worried about the core inflows into the equity markets. The lumpy flows, probably would be HNIs or larger people who are trying to maybe time the market, the so-called smart people who are trying to time the market. But we've seen if the market goes up, they tend to book profits. If the market goes down, those flows will come back. So I'm not too concerned about flows into equity markets. Bottom line is that now local flows have become so strong now, and by local flows, it does not mean only mutual funds. We have mutual fund flows, we have insurance company flows, we have NPS flows, we have EPFO flows, and a lot of other HNIs and family offices now, which have become significantly large. So on a net basis, I think the structural inflow into equities by domestic investors, institutional as well as non-institutional, has become so strong that we are actually in a what used to be our dream phase. When I started my career, we used to see that in countries like Taiwan, Korea, Japan, etc., the locals did not care about what foreigners are doing. And I think we have finally, after 30 years of my career, reached that stage where we really don't bother about what the FIs are doing. We do our thing.
Let's hope the golden period lasts. So, just like it takes a village to raise a family, I'm sure there's a team that helps you manage these funds. So, can you tell me about your team size and how the fund management group collaborates on research and portfolio decisions?
So we have a, what I would say, a very tightly knit, integrated team and very flat structure. So we have 5 analysts on the equity side, we have 2 fund managers on the equity side, and we have 4 people team on the fixed income side, and we have 2 traders on the equity side. So we have a good 12-member team in the investment function, very tightly knit, very fundamentally oriented, and we like to be on top of everything, whether it's corporate earnings, corporate developments. The fixed income guys have to be on top of all the macroeconomic developments, both locally as well as globally. So I think we have a team size which is adequate for the kind of product range we are offering, and these are all very highly qualified, smart people.
Interesting. And if you can share what kind of return expectations should investors realistically set for equity funds going forward, especially in the mid cap space?
As I said, when we talked about the earnings season, earnings have surprised positively for the top 500 companies. But within that, the mid-cap companies actually have demonstrated much better resilience. We expect about high single-digit earnings for the large caps, which is the top 100 companies. We expect about 15% earnings growth for the small cap index, but the mid cap index earnings growth can actually be a little more than 15 to 17%, right? Of course, valuations do account for some of the positives, so they have taken into account. Mid cap index valuations are at a little bit of premium. So in general, I would say at the broader market level, earnings growth should be about 12 to 14%, which is the kind of returns that we should see from the broader index also. My guess is that the mid and small cap indices might give you a little better returns than that.
Great. And just one last question. Looking ahead, what is the outlook for India's equity markets over the next 12 to 18 months? What are the key trends and risks investors should keep in mind?
Sure. So earnings is paramount, as you know. Ultimately, it's earnings that drive stock prices, and we talked about earnings. We are talking about 12 to 15% earnings growth across different segments, which is very healthy considered, considering the rest of the world, what the situation is like. And I would say that we should be a little, cognizant about the fact that we are in a green shoots kind of an environment. So while there are a lot of positives, there are some things that we need to watch out for also. So for India, as I said, versus the rest of the world, we are doing extremely well, no problems. But for the local economy, I would say the good things that are happening is that government spending has finally come back. One of the reasons why we saw the markets correct in the second half of 2024 was because there was a slowdown in government spending because of election time, etc., etc. That has come back. Government spending has come back dramatically. In fact, after the border issue with Pakistan, defense spending has been ramped up dramatically. So not only are we talking about good defense growth in the original budget, but we are probably talking about 50,000 crores extra spending in the next few months, and this is on an accelerated basis. So that can create an impact. The tax cuts that we saw will create an impact. Some of the rural schemes that are being rolled out will create an impact on consumption. So my guess is that private sector capex is also picking up now because of all this. So government is anyway giving a boost both at the infrastructure level as well as defense level. But private sector capex is also, I would say, coming back, and we can see some signs of green shoots there. So these are all the positives we are talking about, including rural consumption coming back. The gray areas, I would say, and which is the one which I would very closely watch for positive developments, is banking credit growth is still not picking up. So we are still talking about little more than 10-11% of trade growth. It should ideally grow to 13 to 14%. Urban consumption, which was doing very well post-COVID compared to rural, is not taking off in the last few months. So I would say that's one little bit of a gray area. And the other risks, of course, are more global in nature, geopolitical nature. We are talking about the Iran-Israel escalation. The Russia-Ukraine thing is anyway going on, and we hopefully, while we have tackled the border issue last month, hopefully it should not start afresh again, on that front. So I think the risks are more global in nature. For the India, the second half should be better than the first half. That's how we are positioning the portfolio.
Let's hope that the second half is better and the growth and the momentum picks up. Thank you so much for sharing your insights with me. It was useful. And any parting thoughts?
No, I think stay invested. Look at the long term, and at any point in time, if there is a doubt, just refresh the India story in your mind.
Thank you so much, Mihir.
Always a pleasure. Thanks for having me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.